What percent of your net worth is sitting in your employer's stock? Not your guess, the actual number. Most people I talk to are off, and they're off in the same direction, low. So here's how to run it, what belongs in it that people leave out, and what your honest options are once you've seen it. Start with what you own. Most people open one app, look at one balance, and treat that as the answer. That balance is usually the smallest piece of it. Here's what actually belongs in the top of the fraction. First, vested shares you're still holding wherever they sit. Second, vested shares you moved to some other account years ago and stopped thinking about. Third, unvested RSUs that are still scheduled to vest. Those are not hypothetical. They're on a calendar with dates on it. Fourth, ESPP shares, including the batch you bought 2 years ago and never got around to selling. Fifth, employer stock inside your 401k, if your plan offers it as an investment option. Not every plan does, so you have to check yours. Then, the bottom of the fraction, everything else, cash, the rest of the retirement accounts, the taxable account, home equity if you want to count it. Keep in mind that counting home equity makes the percentage look smaller. So, I run it both ways and look at both. Practically, that's 3 places. The equity portal from your employer shows vested and unvested and the vested schedule. Your 401k statement shows where the company stock is in there and how much. And then whatever brokerage account you move shares into. Value the unvested at today's price. It's an estimate. I know that. But leaving it at 0 is a worse estimate. And it's the one everybody defaults to. Divide, write it down. That's the version most people have never actually seen. And in my own practice, it usually lands well above the guess. And that's only half the number. The piece almost everybody leaves out of this is their own paycheck. Your future earnings are an asset. For most people under 50, it's the biggest one they have. And if all of that income comes from one employer, then that asset is a claim on the same company as the stock. So run a second number. What percentage of your household income comes from that one company? Single earner, it's 100. Dual income with a spouse somewhere else, it's lower. And that generally matters. Now, put the two side by side and hold everything else constant. 30% of your assets in employer stock plus 100% of your income from that employer is a very different position than 30% of your assets and 40% of your income. Same portfolio, different exposure. The stock percentage by itself doesn't tell you which one you're in. And the two are linked in that direction you don't want. The scenario where the shares fall hard is usually the same scenario where hiring freezes, the bonus gets trimmed, and the next grant comes in smaller. It moves together. That's the actual issue. It isn't that the company's bad. It's that one event can hit your portfolio and your income on the same day. Finner treats company stock as its own separate category of concentration risk, apart from that kind that just builds up because something went up a lot. Here's the research, and here's the best argument against me. Hendrik Bessembinder, say that 3 times fast, at Arizona State, looked at every U.S. common stock from 1926 through 2016. 58% of them had lifetime returns below 1-month Treasury bills. And the entire net gain of the U.S. stock market across the whole stretch came from the best performing 4% of listed companies. That's the Journal of Financial Economics 2018. Keep in mind, that's lifetime returns across the full market, not a forecast about your employer, and past performance doesn't guarantee future results. But it's the only way we can really compare. What it tells you is the distribution is lopsided. Most single stocks are not in that 4%. If you are, enormously. Now, the counter argument, and it's a real one, you're going to tell me the concentration is what built the account in the first place. That diversifying 5 years ago would have cost you actual money. That's often true. I've watched it happen. Some of the balances I look at exit because somebody held through a stretch where selling looked smart. Both things can be true. The position that got you there, and that position is now big enough that one bad year at one company moves your retirement date. Those don't contradict each other. The question isn't whether holding worked. It's whether you take the same bet today at this size with this much of your income attached to it. If tomorrow's vest showed up as cash instead of shares, if the answer is yes, then hold on purpose. That's a decision. What most people have instead is a default. Knowing the numbers does not tell you to sell. I want to be careful here because this is where this topic usually gets lazy. What stops people is not that they don't understand diversification. They understand it fine. What stops them is the bill on the way out. I'm working with someone right now, a tech employee, holding a large RSU position from her employer that has appreciated a lot. It's roughly 30% of her total assets. She wants that money working somewhere else. She's not confused about the risk. She has looked at what unwinding a position with that much built-in gain would cost her in tax. And that is the thing holding her back. Not ignorance, arithmetic. And before anybody decides the tax cost settles it, one thing that gets missed. This position isn't one block. It's a stack of lots with different basis and different acquisition dates. RSUs that vested last quarter have one basis close to today's price. ESPP shares from 4 years ago do not. Averaging all of it together makes the whole position look more expensive to unwind than it actually is. Pull the lot level details first, because part of a position like this usually is cheap to sell and part of it is the expensive part. Most people price the entire thing off the expensive part and stop right there. That's the honest version of this. Two decisions are stacked on top of each other here. One, how much single company risk do we want to carry? Two, what are we willing to pay to change it? Those get answered separately. People who mash them together tend to do nothing at all. So here's the tax piece in plain terms. Shares held more than a year get long-term treatment per IRS Topic 409 as of the 2025 tax year. That's 0, 15, or 20% federal depending on taxable income. And the 20% bracket starts at a level plenty of equity comp households here are already above. Then IRS Topic 559 adds a 3.8% net investment income tax once modified AGI clears $200,000 for a single person, $250,000 married filing jointly. And California taxes the gains as ordinary income. Stack those three and you can see why she paused. So what are the actual levers? 4 of them, and everyone has a price of admission. First, sell into the vest. When RSUs vest, the value is taxed as ordinary income right then, and the vest day price becomes your cost basis. Sell at or near that date, and there's almost no additional gain to recognize. Cheapest reduction available, and for someone still receiving grants, it changes the trajectory without touching the existing position at all. It also only works going forward. It does nothing about the shares you already hold, and you give up the upside on every share you sell. Second, stage the reduction across tax years. Rather than one sale, you spread it out and size each year's gain against the brackets. The price there is time. You're carrying the concentration while you unwind it, and the market doesn't wait for your schedule. If the shares drop in year 2, you sold the cheapest part first. If they run, you'll wish you had sold less. Both of those are live. Third, don't sell anything. Point every new dollar somewhere else. Bonus, savings, the retirement contributions, all of it away from company stock. Concentration falls because the rest of the balance sheet grows. Tax cost of that is nothing. It's also slow. And if the position appreciates faster than you can save, the percentage doesn't move at all. Long runway and a moderate position, that alone can do the job. A position that's already half the net worth, it won't. Fourth, charitable giving with the appreciated shares. If you're giving money away anyway, giving shares held over a year instead of writing a check generally means you don't recognize the gain and still get a deduction. Keep in mind that only works if you're already charitably inclined. It doesn't create money. The deduction is capped as a share of your income in the year you give, without a carry forward. And the rule shifted for 2026. That one needs your CPA in the room before anything moves. There are more than 4 options-based approaches, exchange structures, and they get complicated fast and carry costs of their own. Probably need a much more in-depth conversation than what fits in this video. So what isn't changing? You're going to keep getting paid partly in shares. That's the deal you took. And for a lot of people, it's a good deal. The grants keep coming, and nobody here is suggesting you turn them down. What can change is whether you know the number and whether the level you're carrying is on purpose. 2 things worth doing this week. Run the concentration number with all 5 asset buckets, not just the brokerage balance. Then run the income number next to it. If both are high, you've got 1 exposure, not 2. And if you only have room for one of those, run the income one. It takes 30 seconds and it's the one nobody has ever run. I'm going to tell you what that right percentage is. There isn't one. It depends on your basis, your bracket, what else you own, how long you plan to stay, and how big a drawdown you could take without changing your plans. That's a numbers conversation, not a video conversation. If you want to run yours with somebody, I do a complimentary review and the fee gets discussed there. Links in the description. There's also a session Thursday on 401k fees. Different topic, same habit. Looking straight at a number you've never actually looked at? I'll drop that link in the description as well. Hope that helps.